Will do.
So Jeff and I just started the recording, and we've been talking about different things. But the primary focus for this coaching session is can Jeff and his company, active obviously in real estate, develop a fund of their own. Having a fund for a developer, a land developer like Jeff's company is really important because so many companies in Canada, to a lesser extent the United States, are capital starved, and you've got to solve that problem. And again, before we started recording, Jeff and I were talking about how cash is king, and that if you have access to enough adequate amounts of capital, it's like having jet fuel, right? I mean, imagine if I came to you, Jeff, and I said to you, I have a great idea. I'm going to start a company, a ride sharing company that is going to take on the taxi industry. And to make it a success, I have to go from city to city and fight taxi unions and taxi regulation in every city across the globe. That's Uber Technologies, right? Mm-hmm. And which also became Uber Eats, etc. Well, that is the worst business model you can imagine, except that they had access to unimaginable levels of capital I think north of 20 or 30 billion dollars. I could be wrong about that, but I think it was in the tens of billions of dollars. The only companies in the world that can access that level of capital are mainly American companies, maybe some Chinese companies, maybe a few German companies, but probably not. Mm-hmm. And we're not talking about raising $10 billion. We're talking about raising some fund that will help you develop your portfolio. But still, if we don't address the capital starvation for Canadian companies, whether they're technology companies or real estate companies or anything else, we're never going to get anywhere, especially competing with the Americans. So anyway, I was going to share my screen, and I started to share it, and then I remembered I wanted to record this. So this is a Canadian company called Brookfield, very active in real estate for a long time. And they've raised funds before. And Bruce Flatt, who's the CEO, decided to raise another $15 billion fund. Basically, Jeff, to take advantage of the fact that a lot of real estate is going to be sold at distressed prices, especially office towers. Mm-hmm. There was an office tower in Chicago, I think, fairly recently. I think it was over 220,000 square feet, so not huge, and it sold for $4 million. That works out to less than $20 a square foot.
Really?
Yeah. So Bruce Flatt and Brookfield are hoping to, put together a $15 billion fund and then go buy some of these assets. I mean, what would it cost today to build an office building in Chicago or Toronto?
Can you imagine a couple $100 billion?
Well, it cost probably $350 or $400 a square foot, and it could be as high as $650 a square foot. Well, let's just use $400. That means a 220,000 square foot building would be $88 million. Well, somebody bought it for $4 million bucks. So anyway, so his pitch, I guess Brookfield's pitch is, look, why don't we go out and buy some of this distressed real estate? So anyway, the goal was 15 billion, and they announced, I think today or maybe yesterday, that they had raised 7 billion. So they haven't met their goal yet, but they're almost halfway. Mm-hmm. And they contributed their own capital. So if you were to start your own fund, would there be any capital available from your company, and if so, how much?
At this time, I couldn't really put a number on it, but yeah, there would be our own capital in it.
So would it be $100,000? Would it be $2 million? Is there a range there?
Yeah, let's say like, let's go with $1 million for now.
Yeah, all right. Because I think that's very important. You could kick off the fund with, and you could say, well, and you probably have a couple of suppliers, a couple of clients, that you could pitch, and they would probably chip in another $1 million. So you could, start your fund, and you already have 2 million committed.
Yeah.
All right. So something like that. So I'm going to write that down. 1 million from Jeff. You're going to check your piggy bank, right?
Yeah.
Maybe 1 million from, some suppliers and clients. All right. So maybe you could start the fund with 2 million. That would be a good start. So Brookfield has had success in the past raising money. They did a 30 billion infrastructure fund. So they were building and buying infrastructure, like, one of those private highways that you have in north of Toronto.
Yep.
And then they did a 17 billion real estate fund that closed a few months before they opened this $15 billion one. He's obviously looking at the distressed office market. So his call to action for people who want to invest in this new fund is they're going to buy buildings that are being sold cheap. Let's see. We've always considered ourselves to be value investors, and that often involves taking a contrarian view that is different from the rest of the market for a period of time. Said another, I don't know how many CEOs they have, but here's another CEO, Brian Kingston. So I'm just going to put that in the chat box for now. So, and you can copy it out of there. So you can just get yourself a copy of that article. All right, Jeff?
Yep.
And one of the things I wanted to show you is, this is a Canadian fund called Align Ventures that I was involved with. Basically, it's Chad Robinson and some other people who started a fund, right? And you asked me, do I have any slide decks, that the pitch decks basically, and this was Align. Intelligent mortgage solutions to meet the needs of borrowers, lenders, and corporations. And they focus on the alternative mortgage market. So it's not identical to the kind of fund that Brookfield is doing or you would do, but it's a pitch deck that's kind of related. Okay. So the alternative mortgage market, I'm sure you know what that is. It's people who, probably can't qualify for A lenders, maybe not even B lenders, right? So when you're pitching to investors, and this fund now is about $20 million.
Okay.
And the initial capital raise was 10 million, and that was successful. And then they went out with another 10 million. So again, the Americans, we're talking 15 billion or 30 billion. Canadians obviously, are at a different level.
Yeah.
But it wouldn't be the worst thing in the world if you had a $20 million fund,
No.
And that would be the start. And then hopefully you would get to 750 million to $1 billion for a company that will be the size that yours will be. So that would be kind of the range. And then after that, you'll be 10 years older and you can figure out what to do next. So I wouldn't think you would go out and raise, 2 million. I think your goal, I mean, it's up to you, but I think your goal would be 20.
Yeah, exactly.
All right.
That's what I was thinking.
So when you're doing a pitch deck, and I will share this pitch deck with you, but you can't share it with it. This we're recording this meeting. You can't share this. You can't post it anywhere.
Yeah.
And you can't share this either. It's just to inspire you. Okay.
Yeah, I agree with that.
Right. Thank you. So the alternative mortgage market, you want to establish how big this opportunity. In your case, you've got lots of land to develop. How many acres do you have to develop?
So we got 60 industrial, about 7 acres of residential, like high density, and then about another 45 acres of residential. But that's side.
And what is the scale of development on that? Would it be a $400 million development, $200 million development?
So yeah, the residential one, that's about 500 units. So that'd be, you're probably around 50 million around there. That one. And then the industrial one is we're just kind of sitting on it right now. There's not much planned on that one at the moment.
Well, let's say that the opportunity for development is 100 million to 200 million.
Yeah.
Because you'll find, if you have a fund, you'll find some other stuff to do too.
Exactly.
So I think that the opportunity, you know, a $20 million fund should be able to support $100 million worth of development, right? So I think that's a good scale. So you want to show in slide kind of one what the opportunity, what the scale of the opportunity is at this stage. And so what they show here is the alternative mortgage market. It was at 101,000 when they did this, I guess in 2021. I bet you today it's 500,000 loans out there. I mean, oh yeah, people are suffering. The value of the loans out there is about 45 billion. It wouldn't surprise me if it's 120 or 150 billion today. And there's the average amount, which would be much higher today. And this is their second opportunity, which they wanted. And by the way, I had some input into this, but again, I'm just the coach. So they set it up. It's pretty complicated. I didn't like some of the aspects of what they were doing, but you know, they were pretty determined that they wanted to have a number of different buckets in this presentation. And you can't argue against the fact that they were successful in raising first the 10 million and then the 20 million. Having said that, I suspect that that when they get into you know, they're now operational, but when they get into full operation, you know, 3 years into it, some of the complexity will be, they'll get rid of it, right? Because I'm sure you know this, Jeff, from your own experience, complexity is the enemy of success.
Yeah.
Right. So, I mean, if you do something really well, you think, well, I can do 10 things really well.
Yeah.
Actually, nobody can really, I mean, you know, Connor McDavid is a pretty good hockey player, right?
Yeah.
But maybe he sucks at golf, or maybe he sucks at badminton. I don't know. But I'm sure he's a better hockey player than he is anything else.
Exactly.
And he makes, you know, untold millions of dollars, right? That kid, Patrick Mahomes, is an unbelievable quarterback. Did you watch the Super Bowl?
Yep. Yeah.
I was so bored at halftime, I turned it off.
It was a bad game. Actually, like two guys at the place I watched it, two guys laughed. They're like falling asleep on the couch. They're like, "We're going home."
Yeah, I just thought, oh my God, this is boring. I turned it off. It turned out, I mean, I read about it the next day. It turned out to be a pretty good game. So anyway, so there another bucket of what they're doing is mortgage administration. And if you know anything about how the mortgage industry works, especially the, you know, RRSP mortgage market, you have somebody who has a self-directed RRSP. You have a borrower over here. They're not allowed to connect directly. Did you know that?
No, I didn't.
Okay, they have to go through a mortgage administrator.
Okay.
So it's like a because RRSPs are considered, you know, like they're like I don't know, sanctuaries, or they're considered like churches or something like that. So the government of Canada doesn't allow. Let's say you had $200,000 in your RRSP and you wanted to use 100,000 of it, you know, in the mortgage market. You can do that. You can become a lender, but you have to go through a mortgage administration. This is something I thought was done by other people. Olympia Trust, for example, they do that. I didn't think much, and Canadian Western Trust does it as well, but they added it. Okay, so that was something they wanted to do. I think they'll find that the administration of mortgages is incredibly boring. The margins are small. The operating costs are high. I just didn't think it was a very good idea. So you want to talk about the size of your market and then what it is that you're actually doing. So you have you know, a few projects in mind, and we'll talk more about that in a minute. Then you wanted to, you know, identify the people involved. Adam Rose is the CEO. Chad Robinson, who's a good friend of mine, is the president, and he became the trustee. And then here's your chief financial officer. You want to identify the key individuals. So this was the private mortgage origination business, which is the one that I wanted them to focus on. You know, basically, you've got a line trust. It will lend money to people who want a mortgage, right? And they are a syndicator, right? So they do have $20 million now of their own money, but they often will syndicate a mortgage beyond their own funds.
Okay.
So they will go to other mortgage investment corporations and you know, other companies similar to theirs and say, look, we're doing multi-res building for $100 million. We're going to put a mortgage in place of 80 million. 5 or 6 million is coming from us, and then they would syndicate the rest.
And why would they do that?
Because it gives them more leverage, and they make money on the syndication. In other words, they charge a fee for that. So let's say that the borrower is paying, today maybe 10% on this money, maybe 12 or 15%, who knows? But anyway, let's say it's 10%. They're going to make 1 or 2 points on their money, and then they'll, if it's 2 points, say, on their money, they'll give the people in the syndicate, they'll give the 1% and take another 1% of their money.
Oh, okay.
And the 1% you would take on the syndicate money is an infinite internal rate of return, because it's not your capital.
Exactly.
It's pure profit, or close to that. It's probably 85% profit margin.
Yeah.
All right. So that I like, that I thought was a really good, and you're going to have this slide deck. So, and you're going to have the recording. So if you forget some of this stuff, you can go back. Okay. And obviously, they source money from institutional lenders and family offices. Do you know what a family office is?
No.
So somebody like Bill and Melinda, people like Bill and Melinda Gates have a family office. These are mega wealthy people. They're worth anywhere from a few $100 million to untold many billions of dollars. They have a family office because their personal affairs are so complicated. It's not like, you have a few RRSPs and you own a duplex somewhere. These wealthy individuals have such complicated affairs from a tax point of view, from an operational point of view, that they have what's called a family office, and they actually have people who run their personal affairs.
Okay.
And so that was one of the key things that they did. They met with 3, I think, family offices in Toronto for their second $10 million, and 2 of them put in $5 million each. So instead of having to go to 1,000 people putting in 20 grand each or something, they were able to get significant amounts of capital from 2 family offices. Nice. And you can find them online. I mean, they're not hard to find. And you make a meeting with them and you go pitch them, and that's what these guys did. Okay. And let's see, where are we going next? Oh, I want to make sure I didn't miss something. Okay, no, I got it. Now, one of the things that was important for their growth was to find potential borrowers, and they had a ready-made, basically pre-built network, which they're called mortgage brokers, right? Like you go, if I can't get a mortgage myself, I'll go, or even if I could, I would go to a mortgage broker anyway. And if it requires private lending and they know about a line, that's obviously a referral for them. Yeah. And so on the demand side, a lot of their clients are being referred into a line from mortgage brokers across Canada. And on the supply side, money, they are cultivating all the time. They're cultivating new and existing relationships with individual lenders, so syndicate lenders, and also family offices, and many others who want to invest in this kind of thing. And they are focusing now on more American funding partnerships, because I coach them and I tell them that the Americans just they just dwarf Canada. All right. Yeah. Revenue 2. They like, as I told you, they love the administration side of the business, but I think they'll love it less, as I mentioned a few times now, as they get into the administration of mortgages. I would much rather give Olympia Trust or Canadian Western Trust the few pennies they make a year managing these mortgages or these relationships than do it myself, right? It's just, that is a pain in the neck. But anyway, they put it in there. I suspect that it will disappear. Yeah, I won't go through this because, again, this is not something you would do anyway. All right, we want to go. Let's see what they've got here. Our objectives is to grow the mortgage administration business to $100 million within 2 years and they have approximately 25. I thought it was 20 million, but they have 25 million under contract now. It's a little bigger than I thought. So they do trust management contracts. The mortgage space has traditionally been a small local operation. It's become a focus of regulators on compliance. For sure, that's something you're going to have to be aware of. You have to fall within in Ontario, within the OSC, the Ontario Securities Commission rules. Mm-hmm. Do you have an accountant and a lawyer with experience in this area?
Accounting, we're just in the midst of hiring our new CFO. So I'm not sure until we hire him or her. And our lawyer, I'm not positive how familiar he is in this.
So one of the things you could do as a bit of homework to help us is to ask your chief financial officer, your accountant, and your lawyer if they have any experience in securities law and securities issuing.
Okay.
All right. Because, and if they don't, it's not their fault. I mean, you know, they may not specialize in it, but your lawyer will certainly know somebody who knows securities law, and your accountant will certainly know somebody in the same field. And hopefully your CFO understands this industry too, because we can't really do much without, you know, their advice.
No, that's part of our, kind of not criteria, but one of the things we're looking for this new hire.
Yeah, I mean, it would be a huge help if he or she knew, you know, securities law, and because I mean, as we talked about a few minutes ago, again, if we can get you to a 750 million or $1 billion fund, it's jet fuel for your business.
Yeah. All
right. So how do you raise money? Well, you look at partners. So if you want to write this down, there's some pretty simple ways, I think, for this fund, you know, whatever we call it. Have you got a name for it, by the way?
Not yet.
Well, we'll have to come up with one, right? So we'll call it the Z Fund for now. Z and hyphen fund. All right. Yeah. Just because Zaluski is a pretty cool name, so we'll just call it Z Fund, right? Like it's French. Z Fund. Yeah. So we'll call it that for now. Yeah, you'll come up with a better name, but that'll be a placeholder between the two of us. So if you were going to raise, say, $20 million, I'll bet you it would not be that difficult to do from talking to the people that are in your supply chain. Yeah. As you know, the people in our business who have the most money are the trades and the sub-trades. Yeah. Not the general contractors. No. And generally not even the land developers. It's the trades and the sub-trades. I mean, we've talked about this before. Have you ever met a poor plumber? No. Oh, never. Yeah, but no. No, I don't. Anyways. Yeah, I mean, you know, most of the plumber, I mean, there's some plumbers my age, long since retired now, who own, you know, $50 million, $100 million worth of real estate. That's no accident. I mean, they know how to make money. Electricians, you know, if you run an electrical contracting company, a plumbing company, most of them have money. So one of the things I was going to ask you to do is to reach out to some of the people that you know and trust, who you've worked with, you know, trades, sub-trades, you know, suppliers, you know, I mean, there'd be a million of these guys. You just look through your accounts payable. Yeah. Right. So ask your accountant or your bookkeeper, whatever. Can you just give me a list? You'd be surprised how long it is of everybody we paid money to over the last 2 years. Be a long list. And I'll bet you we could raise $20 million from just that list. Yeah. You know, it might be $200,000 at a time, it might be $100,000 at a time, it might be $500,000 at a time. Yeah. You know, it might, whatever it is, I'll bet you we could raise $20 million from them. So what I was going to ask you to do is to reach out, it's just called like a soft touch. Reach out to some of the people you know really well and say, look, we're thinking about setting up a fund to accelerate, you know, the land development business that we're involved with, and construction and everything else. And, you know, would you be interested in hearing more about it? I'll bet you, you know, if you ask 20 people, half of them say, yeah, sure, because they like and trust you, right?
Yeah, exactly. So would you get like, you wouldn't do that now, like you'd kind of get this a bit more, I guess, set up and going before you do that?
No, I mean, you know what I am like? I'm like New York cops, right? Bang, 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 stop, right? Again, you can't use that publicly. That's a really inappropriate thing to say, but I mean, I'm a shoot first guy and ask questions later guy. Okay, that's me. If you're not comfortable with that, that's fine. But you know, I really like you know, the idea of getting people excited about ideas in a very soft way, that where you're not asking them put in $500,000 right now. You're saying, look, I'm thinking about setting up some kind of a real estate fund to help our company and maybe some others, you know, accelerate their progress. And so wondering if you wanted to hear more about it as I develop the idea a bit more. It's just a very soft, it could be an email to, you know, hey, Bill, you know, I would do it just to gauge, you know, the reaction.
That makes sense.
You might not, I'll just stop sharing my screen just for a minute. You might not like that approach, which is perfectly fine. If you don't, we'll wait till we're further down the road. But I do like it. And I'll tell you, I have been selling vaporware all my life.
So what?
Vaporware. Do you know what vaporware is?
No.
Vaporware is software that doesn't yet exist.
Okay.
I've been selling vaporware in the real estate industry, not the software industry. But I'll give you an example of that. Apple ran like 2 full pages of advertising in the Wall Street Journal and I think the Toronto Globe and Mail. 2 full pages. This is a long time ago. 2 full pages of ads saying, because back then, when you set up a new office, you would put in a PBX, a private branch exchange, and everybody would have phones on their desk, you know, extension 222, extension 223, et cetera, right? And it had voicemail, you know, that was big back then. So you'd have a PBX in your office, which would serve, you know, 100 people or 10 people or 1,000 people. And then you would have a computer network, right? So Apple was in the computer space. And people like Nortel and Mitel and others were in the telephone space, basically, and they were separate spaces. Apple announced back in the days when newspaper advertising was a thing. Today it would be different, but back then, announcing that they had a new system that would do both. And because they wanted to gauge the interest of people in something where they would merge these two, basically 2 separate industries into one. I mean, back then that was a big thing. Like today, we'd take Zoom or Microsoft Teams for granted, right?
Yeah.
But back then that was not the case. So let's say you and I were young guys together and we were setting up an office for 20 people. We back then we would have spent $120,000 to $150,000 on the PBX and all these phone systems, and then we would have got a bunch of Apple computers or maybe IBM computers and brought them in, another 100,000. And Apple said we can do both, and it'll be a lot cheaper. They didn't have any idea how to do that. It was complete vaporware. It was complete BS. Yeah. And because they wanted to see what would happen. And a guy like me, because I had a growing company, we went from, you know, maybe when I started 10 or 12 employees to a few hundred, right? Yeah. And so I was spending lots of money on computers and telephony. And I called Cupertino, California. And when I saw that ad, I said, this is great. I called them up. And they had no idea what I was talking about, the people I was talking to, the product developers. It was total BS. It was marketing BS. The idea was to gauge whether the interest, and they just monitor how many calls they got lots of calls, and they said, aha, that's the direction we're going in. Do you understand? Yeah, yeah. So it's not just Prof. Bruce putting the cart in front of the horse, all right? If you were to email 20 people who are close to your company and you can trust and say, look, I'm thinking about putting a fund together and I'd like your opinion. And 20 people said no, that would be quite a strong indication that maybe we're going down the wrong path. Exactly. Yeah. But if we send out 20 emails and 10 people, oh, that's a great idea, right?
Okay.
That would be an indication that we're probably going down the right path before you spend any money on accounting and legal fees or even coaching.
Yeah, makes sense.
Okay. And on the real estate side, I learned something from that Apple thing. So yes, on the real estate side, I was very interested in mini offices.
Mm-hmm.
Do you know what those are?
No.
It's like co-working space.
Mm-hmm.
Okay. But it's not WeWork. You know what WeWork is, right?
No.
WeWork is the biggest, or was the biggest co-working company in the world.
Okay.
Okay. WeWork was started by a guy by the name of Adam Newman, I think. A complete off the wall crazy guy, and I thought he was leading that company, which was valued at one point at $40 billion, into disaster. And sure enough, 5 or 6 years later, it's going bankrupt. So, but this is now 30 years ago. I wanted to be in the mini office business, which is different from it's different from the co-working space. A co-working space is generally, at WeWork, it would be like they'd have a pub, where you could get free beer. And then they'd have a bunch of, benches and chairs and tables where people would just come in and work and drink coffee or beer.
Yeah.
And they played foosball and ping pong and whatever else, right? So that's a co-working space. Many offices are different, and I thought was a better plan. So we would have private furnished offices. You could come to any one of the many office layouts that we had. You could select an office. It would be furnished. It would have a telephone. It would have fax. Back then fax was a big deal. It would have photocopying. It would have everything you need. You could sign a lease and be operational in your business in Toronto or Ottawa within an hour.
Yeah.
All right. That's a mini office. And that to me is a much better concept because human beings are very territorial. Right. So, if you have just a bunch of, random tables around and I'm sitting at one spot all the time at WeWork and you're sitting next to me, we're not even working on for the same company, but we're just, we're friends and we're just chatting back and forth. And you come in and somebody's sitting in your seat right away. Well, that's my seat. Well, there's no reserved seating here, right? It's, somebody tell you to F off, but you wouldn't like it. So the other thing is we would only put our mini offices into buildings that we owned, or mostly that we owned. WeWork would just lease the space, right? Okay. And the other great thing about mini offices, and by the way, guess who started in one of our mini office complexes in Ottawa? It was Apple. This is the 80s. Apple came to Ottawa with a tech guy and a sales guy. And they rented 2 offices from us downtown Ottawa. And anyway, the other cool thing about mini offices is when you own the portfolio, somebody like Apple would go from 2 offices to 5,000 square feet or 10,000 square feet within a very short period of time. And guess who they would come to for that space?
Yeah.
So we were planting seeds and then harvesting the crop a year or 2 later. So anyway, so I wasn't sure though if this was a good idea or not. So what I did was I asked one of our guys, his name's Greg Graham, to get a phone line dedicated to what was called Terrace Corporate Centers Limited. And we ran ads back then, again, in the newspapers. And there was literally a phone in a cupboard with a telephone answering machine. You see them in the old movies, right? And we would run the ads and see and we got an overwhelming response. And then we built the mini office business and it became very successful. Okay. That's vaporware in real estate.
Yeah. Okay.
So again, I'm not suggesting you have to do it, but I would test it out. I would find 15 or 20 people that you're close to. I would say, look, I'm thinking about this. I'm talking to my coach about it. And I would say in the email that it's to help us and to help others as well. Yeah. Because it would. I mean, let's say your company becomes more successful. Guess who goes up with you? Your supply chain.
Exactly. Yeah.
All right. Okay, enough?
No, it makes sense.
All right. I hammered you on that one, didn't I? All right. Sorry about that. All right. So I want you to write down. So the supply chain is number 1. Just look at your accounts payable. Yeah. Number two would be your clients.
Yeah.
Because your clients may be interested as well. By clients, I mean people you're building for, but also people you're renting to.
Yeah.
It's a way for, if let's say I'm renting some real estate, if I become involved in your fund, I become involved in the real estate industry. So the people that are your clients on the development side, on the construction side, and also your tenants. And then all of the people all the professionals the engineers, the consultants, your lawyer, your accountant, your mortgage brokers, all of those people should be referring people in to you. Hey, listen, I've got a high net worth client. He's getting 4 or 5% on his money, but he's really interested in maybe doubling that to 10% or 8%, right?
Yeah.
So they will be. Then the other thing that I wanted to show you is I've done some work with these guys. I'll show you these guys here. So there are a number of firms that I think you might want to talk to. These are really, I really like these guys. They're not huge, but they tend to listen. They're called Rethink Diversify.com. I'll put that in the chat box in a minute. So Rethink and Diversify is a securities dealer and one of the only securities dealers in Canada allowed to sell investments online to everyday investors. We offer private equity and private debt deals that can provide unique diversification returns that you might find in the public markets, all without the emotionally driven ups and downs. So the CEO of this company, his name is Jason Park, and I'll see if I can find his contact information. Give me a second here. And I really like him. And at some point when you're ready, I'm not saying it would be today or this week, but when you're ready, I think you should talk to Jason. I've got it. Yeah, I've got his information. And these guys, if you wanted to, could help you raise money. I think we could probably do. I think we could probably raise $20 million, Jeff. You and I. Oops. Yeah, I put it in the chat box. That's it. So it's Jason Park. There's his phone number and his email address. But just keep it, on file. So if you are at some point, if you would like an introduction to Jason, let me know. And this is the kind of, they could take you from 10 or $20 million probably to 50 or 100 million, right? They have lots of existing clients.
What are they? They're kind of private equity.
Yes.
What are they? Yeah.
What they do is they would offer their clients the opportunity to invest in private equity deals or into your fund, right?
Yep.
And it also would allow you, because they would do the prospectus for you, but also allow you to open it up to people with smaller amounts of money,
Yeah.
So that if grandma wants to invest, $25,000, she can, and you could have 1,000 grandmas do that, right?
Yeah.
These guys have helped a couple of my other land developer clients, and again, it's relatively small compared to the American side of things, but they could probably take you, as I said, from 10 or 20 million to 50 million or maybe a bit more.
Okay.
All right. And I think you'll like them. They're your kind of folks, I think. All right. Let's see what else we've got here on the Line Ventures. So Line Ventures, let's see. All right. So this was their initial pitch, right? They valued the business at 10 million, and they wanted to strengthen their equity base. So they were pitching to invest funds, but also pitching for equity, if you understand the difference.
Yep.
All right. So they offered 20% of line ventures for 2 million, and they had no problem strengthening and getting that 2 million, right? So they got to they're now at 20 million, and they have an equity base as well, which was strengthened through this offering. What is the purpose of that equity investment? To invest in people and technology. It should have probably said investing in people, technology, and marketing. Okay. What else? Okay, and they were pitching, as you know, the family offices, some institutional investors like First National and MCAP and others. And in terms of exit, I didn't really like number 3 or number 4 because I just for myself, I don't really like building businesses that have a built-in exit plan. All right. Now maybe others won't agree with that, but you know, you're a young person. You could own Z Fund for, you know, for the next 40 years, and what the exit is 40 years from now, you can't even imagine it, right? I mean, I can't even imagine what will happen 5 years from now. I mean, did you expect a pandemic? No. Did you expect the end of pandemic to bring interest rates and inflation like what we had? Probably not. A real estate recession, a war in Ukraine, a war in the Middle East. Well, the war in the Middle East, they're always having wars in the Middle East, but certainly I didn't expect war in Europe. So I didn't really like number 3 and number 4, but that's what they did anyway. And what they're talking about there, Jeff, is in year 7, a liquidity event, right? So they wanted to provide, if you can sort of see this graph here, this was their investment timeline to get to 10 million, which I thought was ridiculous. You know, taking 7 years to get to 10 million, but you know, again, that's what they wanted to show. And then they show a liquidity event here, like, you know, going and doing an IPO or, you know, selling to a larger firm. I thought that was dumb. If you want to have a liquidity event after 5, 6, or 7 years, you know, you can offer to buy their shares back. The company can buy their shares back.
Yeah, really.
I mean, so I thought that was preposterous, and you would never, at least in my opinion, you would never do an IPO for something that was $10 million.
Yeah.
I mean, you know, it could cost you $2 million to do all the legal and accounting work to do an initial public offering, and you're going to go out with a company that's not even worth $10 million. It's no way.
Yeah.
So, but anyway, they were successful anyway, even though I didn't agree with everything in this pitch. And then they had, you know, supporting documents, executive summary, a business plan. Again, I don't think a business plan, and I told them this, I don't think a business plan is really what people want. When was the last time you read a 40, 50, or 60-page business plan?
Like once.
Yeah, maybe when you were at school.
Yeah.
So what people want, at least in my experience, I'm talking about investors, whether they're investing $100,000 or they're investing $20 million or more, what they want is they want the executive summary. That's correct. And they want a sketch of the business model, which is 1 page. And they want a pitch deck, and that's it. Right? Maybe there's a spreadsheet somewhere, but that's about it. Almost nobody. If I were to show this, and I told the boys this, if I were to show this to one of my California clients, they'd laugh at that, because the VC industry, they do a lot of pitch decks, obviously, but they almost never read a business plan. It's just formula and mostly BS.
They got like policies and procedures manual in there.
Yeah, I mean, exactly. I mean, so they put in a lot of stuff here that you know, I would have put in. I'll give you an executive summary. I'll give you a copy of our business model, just a nice diagram of what this business model actually looks like. I'll tell you about the people that are involved, and I have a pitch deck, and maybe I have a spreadsheet, maybe.
Yeah.
All right, and then of course at the end of all these pitches, you have to have some kind of disclaimer.
Yeah,
you can read this for yourself.
Yeah. Okay, so that's what they had. That's what they kind of sent out to.
So what we would do, you and I, with hopefully with your, when do you think you'll onboard your new CFO?
Hopefully soon. We had like three interviews this week.
Oh, cool.
We had we found the golden goose CFO. That was, what was that? Oh, that was before Christmas actually. And he was coming on board, starting the new year and everything, and then last minute, right before Christmas, decided to stay at the job he's at now.
So you lost him?
Yeah, he well, so we are kind of we just kind of have a controller per se right now, and we're kind of growing to that point where we need CFO.
Yeah.
And plus our controller, he's retiring probably next year, end next year. And so we found a golden goose that's from the construction industry, comes from a large company with multiple divisions like us, has real estate background and is passionate about real estate.
Oh, nice.
Has his own rentals and everything. And we thought it was shoe in. His family's up this way. His rentals are up this way.
Wow.
And he was like the perfect and like good guy, our age, like late 30s, I think he was early 40s, kind of our age. And same mentality. He was like the perfect candidate. So we had him signed up and everything, and last minute.
What happened?
I don't know. He just kind of, it wasn't even a money thing because we offered him what his thing, but yeah, he just wanted to stay at the company he was at, basically.
Well, probably the company he's at made him a counter offer.
Yeah, they did, and then we even counter offered that because it wasn't much more than what we were offering, so we counter offered that, and it was he was kind of saying he's staying put. So,
well, things happen for a reason.
Yeah.
When I was hiring my first chief financial officer, I had two candidates, two final candidates, right? One had great suits and, really good looking, very confident, can-do sort of guy. And the other was quiet, he just had a crappy suit on, crappy shoes, and was very quiet. And I wasn't sure. I mean, I liked them both, but they're very different. And I was very, very fortunate. I didn't go with the flashy guy. I ended up with a man by the name of Cyril Leader, who's the president and CEO of the Ottawa Senators today.
Okay.
And he and I have worked together now for, it's got to be 35 years.
Oh yeah.
Cyril's the kind of guy, he's not flashy. He's not. He's very quiet. In a meeting with 30 guys, or 20 guys around a table, we might talk for 50 minutes and you wouldn't hear a word out of Cyril. Yeah. And as the chair of the company, I would say to everybody, okay, we've talked, for 50 minutes around the subject. Now everybody, be quiet. Cyril, what do you think? Yeah. And in 5 or 6 minutes, he would sum up everything and he would make a recommendation, almost inevitably correct. Really? Yeah. So sometimes things happen for a reason. If this guy was the perfect candidate, but he strung you along, because he accepted your offer, right?
No, he didn't formally accept it.
Oh, he did not formally accept.
He did not formally accept.
I was hating on him for the wrong reason.
Yeah.
But because if somebody signs something, they should do their utmost to live up to it, right?
Exactly. Yeah.
Should. I mean, none of us are perfect, but we should. So, but it just gives you an opportunity to find somebody maybe who's even better. Exactly.
So it's one of those positions you can't rush, right? So
100%.
We're taking our time with it.
And if he or she has experience in real estate and experience in the security side of our business, that would be huge.
That would be.
Or even if they don't, but they have a capacity to learn.
Yeah. Yeah.
So I tended to hire young people when I was at Terrace Investments Limited and with the Senators and other companies I was involved with, because I didn't really want a lot of experience, because in the real estate industry, people who come with a lot of experience sometimes come with a lot of prejudices.
Yeah.
And, how old again are you, Jeff?
32.
32. That's great. And so when I was your age, 32, I hired a whole lot of guys who were 25, 26, 27, 28, who were smart guys.
Yeah.
Obviously didn't have a lot of experience, but I could train them.
Yeah.
So if you find somebody who's got, and what I was looking for was obviously bright, talented guys with good quality about themselves, good values, and a good heart.
Yeah.
Guys who wouldn't quit when the going gets tough. That guy who didn't accept your offer quit when the going got tough, right? He went back to the safe alternative. So you're looking for people who have great learning potential, have a good heart, have good values, right?
Yeah.
And that you can train. They don't bring a lot of bad habits with them.
Exactly.
Right. I agree with that. And even if I were starting a company today, that's what I would look for. People in their 20s and 30s that I could train, even at this age.
Yeah, that's we have pretty young staff here actually, so it works out good. Like we're pretty good at training people up, bringing people up throughout the company. That's what we like doing.
And you may have heard me say this before. The difference between a young person and an old person isn't the number of years. It's their ability to learn.
Yeah, exactly.
You probably know old 32-year-olds.
Yeah.
They're guys that you absolutely know who say, you can't teach me anything. I know everything. Yeah. Well, that guy's old. Mm-hmm. He's not learning anything new, and he's boring.
True.
You have some friends like that, I'll bet.
Yeah, 100%.
Yeah. They know everything. No, nobody knows everything. And you could be 72 like I am, and you can still learn lots of new things. All right. So I think one of the things we should look at, I opened it up here, is, well, before I show you that, I want to show you this one. This is just for fun. I opened this one up for you. I want to show you something that was a pitch deck, nothing really to do with establishing a REIT, a real estate investment trust, or a mortgage investment corporation, or private equity fund, limited partnership, general partnership. But this is a company I coach called Small Living Company. And they are busy creating tiny house towns in Ontario, in Mexico, in Cancun, and Tulum, in BC. I mean, it's really cool what they're doing. And one of the things that we're heading towards, I think you and I, is a webinar where we get maybe 20 of your closest associates, suppliers and others, on a webinar after we've worked on much more of the details of what you want to do, and we try and raise 10 or $20 million on that call. All right. But I'm big on these webinars, and again, they're obviously private webinars. So this was a webinar for this company called Small Living Company to sell tiny homes, and what their model is very simple. It's really the trailer park model, but you can't use the term trailer park anymore ever since the Trailer Park Boys were on TV. Yeah. So tiny hometown has a lot more cachet. I don't know if that's even a word, but it has a lot more, better reputation than a trailer park. So the way trailer parks work is a fantastic model. Is you own the land, and investors own the tiny homes or the trailers. And so investors own those, and they rent them out, and they pay you land rent. Yeah. All right. That's a fantastic model. And at some point I'd like you to do one, because they're so profitable, it's ridiculous. We've actually been talking about it. Like our one of our pits is coming up. Probably we're just starting to rehab it now. Hang on a second. I just had to turn my heater on. It's getting cold in my office. Oh. Yeah, so actually, one of our gravel pits, it's coming. It's basically finished, so we're actually starting to rehab it now. No way. And it's kind of out in the country between Woodstock and another town. That's kind of the location. And actually, the city's bringing water out that way pretty soon, so we're actually thinking about doing not like kind of tiny homes, like the
modular trailer kind of thing. We're kind of looking at that.
Oh my God, Jeff, you're talking to probably one of the world's leading experts in tiny home towns. I coach two large tiny home town developers, and both are based in Colorado.
Oh, really?
I know this industry really, really well. I'll show you another one of my clients that it's public knowledge. Hang on a sec.
Yeah, 'cause let me see what's one we're looking at.
Hang on a sec. Wait till you see this. Just give me a sec. I'll find the right one. Here we are. Oh, maybe it's this one. Yeah. So this company here, actually it's another Canadian company. Do you know these guys, Park Bridge?
No.
All right. So Park Bridge started out probably about 30 years ago now. And they do what we would call today cottage parks. All right. RV parks, trailer parks, modular home parks, tiny home towns, right?
Yeah.
So Parkbridge had, I think, 2 or 3 locations 25 or 30 years ago. And their business model wasn't quite right. So we changed that to what I just described. And they have gone from 2 or 3 locations now. I think they're over 100.
Okay.
And it's a very simple model. It could be tiny homes, it could be modular homes, it could be RVs. It doesn't really matter. It could be trailers. And what they do is they go in and they put roads and services in. They sell these modular homes to either to investors or to end users, and then collect land rent for the next 100 years, right?
Yeah.
Their internal rate of return, Jeff, is close to infinite.
Really?
I'll explain how that works, but I'll just show you a few more pictures. I'll put this in the chat box so you can explore it, all right, on your own. Because I don't want to take up too much of your time on this.
Yeah, the one we're talking to, Killam Apartment REIT.
What are they called?
Killam Apartment REIT.
Okay.
They do some modular homes.
Can you put their I put Parkbridge the URL in the chat box. Can you put Kellum in
you do that?
Chat box?
In the what?
In the chat box.
Oh, the chat box, yeah.
So I put in some other stuff in the chat box, right? Rethink and Diversify is there.
Yeah.
Did you get his contact information?
Yeah.
And I just put in Parkbridge as well.
Yeah, I just sent you the link there. So that's
I got it. All right. So I'm gonna put it over here. Well, I'm glad I put this slide deck in here. I mean, it was to show you the quality of the work that we need to do. Oh, this is really interesting.
Yes, they did one like in Listwall they're about
I'm looking at it.
Yeah.
Oh, that is really cool. All right, so let me just go back and explain the Parkbridge model and some of the changes I made to the business model. It's pretty simple stuff. So they would buy a piece of land, usually commercial tourism zoning or something like that, and they would put the roads and the water and the services in, septic and electricity, and these days, of course, internet. It basically was costing them about $40,000 a lot to put all the services in. Right. By the time I put the roads in and did all the planning work and all the rest, it's about 40,000 lots, which is quite a lot. So if you have 100 lots, at 40,000, is that $4 million or 40 million? I got a better check. 40,000 times 100. Yeah, it's 4 million. So it would cost 4 million to do the services, and then they would, then they would buy these modular homes and they would rent them out. I thought their model was very capital seeking, capital intensive. So what they did was they changed the model so that what they would try and do is they would buy modular homes at a wholesale level and sell them to either an investor or to an end user and try and make $40,000 profit on each one.
Okay.
So now your cost of putting in this roads and services were 40,000, and you made a profit on the sale of the unit. It could be an RV, it could be a tiny home, it could be a modular home of 40,000. So your cost base for your roads and services was zero.
Yes, yeah.
And so you bought the land, that's true. So you have some cost, but essentially very, very low cost. And now you're collecting $500 to $800 a month plus HST.
Yeah.
Plus selling utilities, right?
Yeah.
Retailing utilities for the next 100 years.
Yeah.
So, I mean, and so when they changed their model, their growth accelerated from this to this. I mean, it really was a hockey stick curve.
Yeah, yeah.
Because
Yeah,
the amount of capital they needed now was so much less.
Yeah.
And I made one other change to their model, which was really important. I said, stop buying vacant land and doing all the planning work, and putting all the services in. Let's go and find campgrounds, not trailer parks, but existing campgrounds, because they already have many of them. You know, they have a little store there. They have the road network. They often have water and septic, right? So a lot of stuff is there, but these campgrounds are being run by grandma and grandpa.
Yeah.
And they usually run very, very badly. Yeah. And they, you know, and the kids and the grandkids don't want them. Like if grandpa says, hey, Jeff, you could take over my campground. You saw how hard grandma worked on that thing all their lives and never really made any money.
Yeah, yeah. So
now all you do is you go in there and you add to your modular homes and presto magic, you're in business, right?
Yeah, yeah.
One of my young clients, he's a realtor, or he was. I told him about this model. So he bought locally here in Ottawa, he bought one of these campgrounds, and he did exactly that. And now that's the only business he's in. He's not a realtor anymore.
No, that's smart actually. There's a few of those old trailer parks around here.
Well, you know, there's a lot of competition for trailer parks because there's lots of people like, I think, Killam REIT. I've heard of these guys actually. Killam REIT, they're smart guys, right? There's a lot of those guys around who will buy trailer parks, but there's not that many who have figured out that campgrounds could be easily converted to tiny hometowns or modular hometowns.
That's what I mean. Yeah, if you buy a trailer park, kind of remove everything, and then
I don't like putting in a bid and having 6 or 8 or 10 other bidders, right?
No,
you know,
exactly.
That's not my deal. I can tell you with Parkbridge, you know, I wanted them to go into the United States with this model, which they didn't want to do. They have, you know, they're a couple $1 billion company, I guess now, but they could have been a $100 billion company or $50 billion, right? If they'd gone to the States, because there are so many campgrounds like this where grandma and grandpa just want to get rid of it. And their kids and their grandkids don't want any part of it because they don't have the model, right?
Yes, yeah.
I mean, if somebody like you, if your grandfather owned a campground that was unsuccessful, you'd go in there in a second and convert it.
Yeah, exactly.
But you're a smart person.
It makes sense too, just like with just the housing market as it is now, like just these affordable houses, right?
Now it's too hot.
But yeah, look, especially the current market, like you know, someone my age, if you don't have a house already, you're kind of screwed. So something like this for your entry level house it fits in perfect in today's market.
I love this idea, Jeff, and we're going to talk more about it. Yeah. Do you know the motto of the tiny house movement?
What do you mean? What do you mean?
Well, the motto.
The motto. No, I got pretty serious into it. I don't know, probably 4 or 5 years ago before I built my house.
Okay, read that.
Less house, more life. Yeah, I didn't know that because I was going to build my own about 4 or 5 years ago.
Yeah, you know, I own a number of tiny houses.
Yeah, you're saying that.
You know, so the other thing that I mean, if we get to do something with this gravel pit, man, I'm excited about that because there's another little wrinkle that Parkridge didn't do it, but the other guys that I'm about to show you, they're into it in a big way. What we're doing is we're doing tiny houses and workshops, small workshops. It is a huge deal. You know, I don't have that many, but I have on one site, I have, I think, 9 workshops, and I have 11 tiny houses on one of my sites.
Okay.
And so the people I attract are not like the trailer park boys. If you know, do you know the television show I'm talking about?
Oh yeah.
Yeah. I mean, they're always smoking, and they're big fatties, and you know, they're always up to, you know, no good, right? That's not who I attract, right? So what I attract are, you know, I've got one guy, he makes handmade guitars. I've got another lady, she makes handmade soaps. I've got another guy, he makes kitchen cabinets. You know, these are people, and they want to live and work in the same area. So they'll rent a tiny house from me, and they'll rent a workshop. It's a fantastic.
Oh, that's what you mean by. I thought you meant like workshop, like you put on workshops. But okay, so you build in like kind of a workshop in that community. Okay, makes sense.
I'll show you one of the ones I'm working on now. I mean, it's not quite finished, but I'll see if I can find it for you. And I buy these like super cheap, and from a company in Smith Falls. Did I ever show you these?
You might have.
I might have, I think so. But I'll show you. It's hilarious, really. So this is one I bought for a young woman. She's already got one of my tiny houses, and she has a side hustle, which I'll show you in a second here. So this is a little workshop, and you know that Ontario changed the building code to allow sheds that are 161.5 square feet.
Yeah.
Without a building permit.
Yeah.
So guess how big each of my little workshops are?
Just under
160 square feet. So they come on a lowrider trailer like this.
I can't see your screen. It's still the
You can't? Shit.
No, I see your screen, but still you're on the wrong screen. It's still
I think I am
on there.
Okay, so can you see it now?
Yeah.
So it comes on, sorry about that. So this is a 160 square foot workshop. It comes on a lowrider truck.
Yeah.
And then in the next picture, you know, it's a tilt bed, and they just lay it down on not even a concrete pad. They just wanted a gravel pad.
Yeah.
Comes on runners, and this is kind of what it looks like. It's got a little overhead door. One happens to be in the rural area of Ottawa, so it's next to a pond. You know, it is insulated, or it will be insulated.
Nice.
And it has, you know, as I said, an overhead door. It has a man door. It has some windows.
Yep.
You know, so what we're doing with this now, as we speak, is we added the electrical.
Yeah.
Then we spray foam insulation. And after that, we put in lights. And you know, we put a reverse cycle heat pump on the damn thing.
Oh yeah.
You know, so you get heat in the winter, and you get cool in the summer. And there's her car. And this young woman, I'll show you her site. You'll get a kick out of this. She runs a company called so she makes fabulous clothing for young women, fashion forward young women, mostly in the States. Our company's called proofcanada.ca. And you know, these are you know, women with, you know, young women, obviously, with lots of money. And she just
I didn't see the prices on those things. Jesus.
Oh yeah. I mean, and they pack into a package about this size, you know, and you know, these are mostly, her biggest markets are Michigan and California. Young women, obviously, these women have lots of money spend it on makeup and hair and dresses and everything else. So so she does all of this work right now in a 160 square foot workshop, and she's very successful.
Yeah.
She makes $120,000 US a year for herself.
Really? That's good.
Yeah. And she has a little tiny home that she rents from us, and then she has this workshop about 30 feet away.
That's cool.
That's cool. So if you have a tiny house town,
Mhm.
if you have a tiny house town that has, obviously tiny houses, but it has a few workshops, you have a live work condition and it changes everything.
Yeah, it does. Yeah.
Becomes a learning community, a cooperative community. I mean, she's in an area now, I think I've got, like I said, I've got 9 or 10 workshops in that area, and they all help each other. It's
Oh,
really
really?
incredible. But
That's
you
cool.
could do it on a much bigger scale. How big is the gravel pit?
Oh, I forget how many acres that is in total. It's be around over 15 acres.
How many?
15?
I bet you it's bigger than that.
Yeah, I forgot off the top of my head because we're using 10 right now, and the other half that we bought was already rehabbed. So I always forget what that second amount is.
Say that again.
When we bought it, there was already existing pit,
Mm-hmm.
and the other half is already rehabbed, and it's a farmer's field now. So we're using 12 acres right now, and I always forget about that. So it'd be around 20 acres,
Yeah, okay.
25 acres.
Let me show you one of the tiny house towns in a different area that I'm working on now, and then we'll get back to the subject matter that you wanted to discuss. So this is another tiny house town that I'm working on.
Yep.
I can't remember how many units here, but this would be, I think, close to 60 or 70, something like that.
Hmm.
No, it was over 100. I counted them. It was over 100.
Okay.
And it has a pond, which is important, right?
Yeah.
You notice the parking is, not everyone has a parking. You have to walk a little bit. We're going to make some changes to it because I'm involved with this. There'll be some changes to it, but each one of these are tiny houses, and at the end of some of these tiny houses, there will be workshops. So you've got sort of a live work condition here, here, here. This is kind of random, but there you go. The highway is here. We're going to develop some commercial here. So there'll be a convenience store. There'll be some fun stuff to do, play, I don't know, outdoor ping pong, play bocce, maybe a food truck, so you could get a burger and fries, because there's a busy highway here. So we'll develop this area here for commercial, and then the rest will be a tiny house town. And the demand for this kind of thing, because how many people can afford, like I've got a client in Richmond, a young guy, he wants to buy a house for himself and his growing family. What do you think it costs just to buy an average house in Richmond, BC?
Oh, BC? In Richmond, BC? 1.4?
I would have guessed, around the same. Starter homes in Richmond, BC are at $2 million.
Yeah, that's crazy.
I mean, for a young person, I mean, obviously you're in a different situation than most young people, but that's tough.
It's possible.
That's very, very difficult. Like one of my daughters was living in Toronto, and she got married, and they wanted to start a family, which they have done. And like a 3 or 4 bedroom townhouse in Toronto was $2.7 million.
Yeah.
And they both are very successful, both her and her husband. They make amazing amounts of money. But they said to hell with it. They moved to Whitby and bought a nice house for 800,000.
Yeah, why not? Yeah.
I mean, because she only has to go downtown Toronto once or twice a week instead of every day. So she can take the GO train and be there in about 55 minutes. So she has to do that once or twice a week, not every day. So, and he actually works between Whitby and Toronto, so his commute is a few minutes.
Yeah. Yeah. It's that's what we've seen, especially our way, just people fleeting the Toronto market and the GTA market and coming our way, especially during the pandemic.
100%. But even in your area, what does a starter home cost?
They're saying around like 800,000.
Yeah, so about similar to Whitby then.
Yeah, but like it's funny, we in our residential subdivision, we started our own home building company 2.5 years ago, 2 years ago, and we're doing some, some higher end houses for the area and
Yeah.
selling around between 1.5 to 2 million.
Yep.
And because the reason we started this because we couldn't find a good builder to build on our lot.
Yeah.
But all the local the home builders around town, they're just howling at us because first of all we started a home building company right when the housing market crashed and for the pricing of it. But yeah, they're selling like hotcakes right now.
That's fantastic.
It's slowed down in the fall, but now that springs come along, and we sold 3 last week with a conditional on
Wow.
4th. But yeah, they're all around 1.8 market, and it's all people from out of town coming to Woodstock, and yeah, it's coming along.
Well, we're all over the map today, so I want to show you one of my.
Yeah.
It's okay. I mean, coaching should be a little bit creative too, right?
Yeah.
This is one of my clients, a big home builder in Florida, and since you're building, nice homes I just found that out like 2 minutes ago. I wanted to show you this floor plan. This is Lennar Homes in Florida.
Mhm.
And it is a fantastic home plan. So look at this one first, all right? They're both the same anyway. So you come in here, you got a 2-bay garage, you come in here, you've got a den, obviously you've got kind of a powder room or bathroom here, a couple of bedrooms here, great room, kitchen, pretty standard dining room, master bedroom, walk-in closet, master bedroom, laundry is here. But what they did, because I'm big on, making homes multi-generational,
Yep.
what they did was they added this here in blue.
Yeah.
So you've got a little garage here. You can park, a small car in there. You come in here, you got a bathroom there, you got a bedroom there, you got a little bit of a living, dining area here. There's a kitchenette, and it is connected to the house. But if you close that door and lock it, it's completely private, and that's the entrance to the outside. So the front door and the side door going into the the 1-bedroom micro suite or apartment. It is at 90 degrees. So from the road, it doesn't look like a multi-unit building. It is fantastic. And I'm going to show you their short video. It's worthwhile putting on the record here. Hang on a second.
As our world changes and generations of families live together under one roof, Lennar.
Can you see it okay?
Yep.
All right. So this you'll see here. Now look at that. When you look at that, that looks like a single family home, right?
Yeah, exactly.
So that's where, the family lives. And then here, now this is the key thing here. Let me just go back a little bit. So you can see how it works. There's the main home, there's the 2-car garage, there's the single-car garage. You can sort of see the side door here like that.
Yeah.
It is fantastic.
That is smart.
Isn't that fantastic? And I'll tell you, again, let's see if they've been selling these, and it's not just, they're not just selling them. Let's see if I could find it here. Yeah, I'll go back here. They're not just selling these to people who want to be multi-generational, Jeff. They're selling these to younger people, who need some extra income.
Yeah, that's what I have. But it's more, well, because in Canada we have basements. It's more level. Kind of a granny flat, but with the separate entrances, 2 gas, like separate meters, separate furnace, everything.
But
that's actually what my house is. I built that myself 4 years ago. And so I live upstairs, and then my basement, just rent that out, but it's got 2 furnaces, 2 hot water tanks, everything. And it's a great plan. Pays my mortgage. Nice.
It's fantastic. Grab that link out of the chat box. That's Lennar Homes. They're huge. I don't know how many houses they sell, but they're
big. They're down in Florida, you said?
Yeah.
Okay.
So, and I'll show you one more just before we get on to the next subject. This is another client of mine based in Ottawa called Phoenix Homes. So they came up with the name Income Series Homes. And they were the first guys in Ottawa. Let's see what we have here. First guys in Ottawa to really understand the value of offering this as an option. So these, look at the prices they're getting on these. Like for Ottawa, these are very high prices, $1 million to $1.3 million. And you know, they're on, look at that, over $1 million on a 35-foot lot, almost 1.3 million on a 50-foot lot. And what they, and I love the, then here's one a little bit smaller, a little bit cheaper, but cheaper being $1 million is ridiculous. So what they have done, what Phoenix did was they came up with the name Income Series Homes, which was that, I can't claim that as my idea. That was their idea. I thought it was great, a great name. And in the home building business, they now offer, Phoenix does, they now offer a basement suite as an option.
Yes, yeah.
So it has its own entrance, its own meters, all that good stuff, but it's an option. And I don't know what your margins are, but most of the home builders that I work with have margins, gross profit margins of about 13 to 15%.
Yeah.
So not really all that great. And then they make about 40% on their upgrades, you know, nicer cabinetry, nicer plumbing fixtures, nicer electrical fixtures. So they can push their margins up by selling upgrades.
Yeah.
But on a 2-bedroom lower level suite, Phoenix charges, I think, about $110,000 or $120,000 for that 2-bedroom suite downstairs. But it only costs them about $55,000 or $60,000 to put in.
Yeah.
So their margins on that option is over 80%.
Yeah.
So 13 to 15, 40. So once Phoenix put it into the marketplace and saw the appetite there, they got the religion and they do it now for a lot of their homes. So it's a tremendous, so it could be multi-generational, or for example, I could do, if I had people coming to my office, I could have my own coaching practice, and it could be downstairs with its own entrance.
Yeah.
So it could be your business, it could be rental, it could be Airbnb, who knows what it could be.
No, exactly.
So I hope you build lots of those.
Yeah, they are. That's one of our big upgrade packages, because a lot of the demographic that's moving in there, they're multi-generational culture. So they love it.
If you have some Indian clients, you know, or from Pakistan, I mean, they'll have 3 generations living there, but white people are doing it too, you know.
Yeah, not as much, not as common, but yeah. So we purposely leave the basement unfinished and then have that as an upgrade slash option.
That's fantastic. Well, when I was discussing this with Phoenix, they weren't really convinced. They thought they'd have to pay a second development charge. I said, no, you don't. And then they thought there wouldn't be much demand. Well, yes, there is. And you know, it's gone really, really well. And I encourage this. And you know, like we have in my house here, we have a really nice basement suite. But I don't make any money from it because my youngest son is there. He broke up with his girlfriend, Jeff, he's your age, and he broke up with his girlfriend, and he said, Dad, can I use the suite just for 3 months? It's now been 3 years. So my wife and I are sort of hoping he'll find another girlfriend.
Yeah.
To move out.
It's nice living with your parents, though, for a certain point.
Well, he in his case, he's got a job as a project manager. He's quite successful, and he saves $40,000 a year by just
exactly.
His mom makes his meals, buys his beer.
Yeah,
you know.
that's what I did. That's what I did for as long as I could, and then which it's nice because you're actually able to save up some money.
Oh, for sure, yeah, and he's really good company for me too. He's a hockey fan, so.
Well, yeah, that's what I like. Like my parents would always kid around, like get out of the house type thing, and I'd be like, if I left the house,
Yeah.
what would you guys do? I'm like, you'd sit here and just watch the Leaf game by yourself.
Yeah, no, I enjoy his company, and I know my wife, adores her youngest, so there you
Yeah,
go.
exactly.
So what is the address of the gravel pit? I just want to look at it.
Find her here. Actually, I might be able to find it on Glimmer here, and then I can give you the actual.
If you can give me a pin, that'd be great.
Yeah.
Have you released the pit license yet?
No.
When will when will the pit be exhausted?
It's getting there now. We're just, you know, just keeping it for our own, just kind of storage yard and everything.
Oh, cool.
Like we, bringing our material back there and crushing concrete and whatnot. So it is. Here, I'll copy and paste it to the chat there.
Put it in the chat box. All right.
Now that I pulled up on Glimmer here, so I should be able to get.
Let's see what happens. Google's pretty smart, eh?
Yeah, I got on Glimmer here, so I can pull up the actual dimensions now for acreage.
So would this be it here?
Yeah, that's it there.
And do you know where the water table is here?
It's pretty low. I forget off the top of my head.
Or pretty high?
Yeah.
So when you talk about the water table, a high water table means that you dig down, less than a meter, there's subsurface water.
Yeah.
A low water table means that you dig down, 5 meters and you still haven't hit water. So do you know where the water table is?
So it's low. Because we're probably at one point they were probably about 100 feet lower than that road right now, and we're not hitting water.
You're saying that the water table is down 100 feet?
Yeah.
Wow. I wonder about that, Jeff, because look at this. You've got a stream there.
Yeah, but it's low in that area.
So if you were to bring a backhoe on here and dig a 12-foot pit, would you hit water?
No.
Wow.
Like
that.
that.
Sorry, what is the elevation difference between here and here?
Where your mouse is, currently, you're currently right there, right now, you're probably close to 100 feet.
That's
down right now.
So you must have a lot of additional material.
Yeah, it's not. It's mixed in with a lot of clay and stuff. So it's not it's not worth going after.
Okay. So basically, you're saying that this is like a hill here.
No, that's down, from that road.
Okay. I'll have to take your word for it because this isn't making any sense to me. I'm a civil engineer, so I'm not saying you're wrong. I mean, I don't know.
Yeah.
I'm
so
sure
if you go, from down there, you see no hill, but at the back there, we're about. Yeah, so this is an older map, but
it's hard to see. So you're saying from here, the elevation
here,
to
so that's where
is like huge.
No, so right there is flat. So if you go back a bit more, that's where we dug out. So if you go straight back, Yeah, so that's all dug out currently,
Okay,
and that's where no, not that far back, a bit more.
yeah,
Yeah,
no, I'm
so
just
right,
looking,
yeah, so right where the pit kind of ends there.
whatever.
That's about 100 feet lower. Yeah,
So, and what is this over here, little town?
little town of Embro. Yeah,
That's cool. What's it called?
Embro.
Emerald. Okay. So you're thinking that this would make a good tiny house community?
Yes, that's what I'm thinking.
100%. I agree. All right. Okay, enough. So we're going to go back to the slide deck, this one here. And once you and I, and maybe your new chief financial officer, your lawyer and accountant, we've decided, are you going to do a REIT? Are you going to do a limited partnership, general partnership? You're going to do a private equity fund? What is this thing going to look like? Maybe it's a mortgage investment corporation. I don't really know. And I'll send you something after we finish on that you can read. It's just a couple of pages on what the difference is between these
Okay,
things.
perfect. I was gonna ask you that, so yeah, if you could
No,
send me something, that'd be
I
great.
have that. If we had a little bit more time, I would go through it, but I think it's more important. You can read that. I mean, it'll just say, this is what a MIC is, this is what a REIT is, this is what a private equity fund is, et cetera. And it's going to be a real discussion between you and me and the rest of the group. We have to understand what the corporate organization looks like. That's first and foremost. And then we'll do the business model, and then we'll think about what the pitch is. We'll put together a slide deck, and then we should do a webinar. It'd be
So like to get a business plan and all that in order, like is it crucial to get what you're going with, like a REIT?
Yeah. So
fund?
the soft approach that we talked about an hour ago is you sending out an email to 20 people and saying, look, I'm thinking about putting together a fund to help our company and others, with land development.
Yeah.
And like your opinion. So that's just a soft approach to 20 people. Hopefully 10 of them or 12 of them say, yeah, I'd like to know more.
Yeah.
And then we decide what is the right structure. Do you want to do the private equity fund, the mortgage investment corp, the real estate investment trust? What does that look like?
Yeah.
And once we have that, then we can start to say, okay, we're going to raise $20 million, and we're probably going to do what Align Ventures did, which is have some equity, have an equity component, because that gives you a little bit more stability, and you'll have lots of debt.
Yeah.
In the fund.
Yeah.
And once we understand what that is, then we can have our first webinar with folks who are interested. Maybe the minimum investment amount is 100,000. Really no upper limit. Maybe 5 million is the upper limit.
Yeah.
And raise 20 million bucks.
Yeah.
So what people will do, and remember I said we'll have a reservation form, like literally a one page. You probably have a reservation form for all kinds of things, one pager which just says, hey, I'm interested in the new Z fund. I'm going to put down, $5,000 or $10,000 just to as a placeholder. Send me all the documentation. I'll get my lawyer and accountant to study it. And then that's called red circling. That's an actual term in the industry, where people who are going to fund the fund, who are going to invest in the fund, they red circle, $100,000 or $5 million. They red circle it, say, yeah, I'm going to reserve $5 million to put into the fund, subject to due diligence.
Yeah. Okay.
So it's a one-page reservation form. It just basically says, I'm interested. Here's $10,000 as a placeholder. It's refundable, right? It just goes to your lawyer's trust account or your accountant's trust account. And it goes in there, and then they get all the documentation. If they like it, then you close on the deal, or they don't like it, they get their $10,000 back.
Okay.
So this is a pitch that we made for small living company. They're, like I said, they're building tiny house towns in Ontario and in Mexico and BC. I think they're doing one in Tennessee as well. Water is important. That's why we went on that long detour. I don't know if the quarry could have a pond, maybe not.
You could support a pond there for sure.
You could, eh?
Yeah.
I think that'd be. very helpful.
There is a pond there now, so you could build that in.
Okay, so that would be a huge help.
Yeah.
And they added to the tiny house town lots of cool stuff, a beer garden, a barbecue truck, like a food truck, all kinds of things. Oh, and they're near a golf course. They're right next door to a golf course, which is really cool. Yeah, I already said that. I forgot, this is also important. They have a craft brewery. The golf course has a restaurant and a craft brewery and meeting rooms and all kinds of cool stuff. So that's just that was just a great addition to this particular location. Then again, they establish, the demand for glamping, tiny houses, Airbnb, vacation rental by owner. This is just all background stuff. Again, they're talking because a lot of their tiny homes are rented for glamping purposes, right? So you can see that the industry is moving along quite nicely. You remember I said that they understand that to expand quickly, they're going to do a park bridge, which is go after campgrounds, right? That are doing so well. Again, just more stats on glamping continues to grow. Why people want to experience glamping. You got to remember these tiny homes are owned by investors. My wife and I, actually, my wife owns one of them too.
Yeah.
Yeah. Just again, more stuff to back up their claims. What is this? Obviously, service and amenities are very important. Whether it's a tiny house town for permanent residents or it's a glamping resort, Wi-Fi, good internet is absolutely essential. I don't have to tell you that. And what do people like to do? Food tourism is big. The one thing that they didn't have in here, but I think is really important, is something I say all the time. Whether it's an industrial building, an office building, a retail plaza, a new subdivision, I add entertainment uses. So that could be simply what I talked about before: a bocce court, a badminton court, a volleyball court, a pickleball court, a food truck, right? I mean, just things that are fun to do, right? It's very, very important. What else did they have here? Oh, they're making a film about the work they're doing on tiny house towns. Oh, nice. I think it's for like one of those television stations like HGTV or something.
Yeah.
This is analysis of Ottawa's marketplace. So they established that. What are some of the revenue opportunities? One of the things I got them into in a big way was not just short-term rentals or long-term rentals, but medium-term rentals. There's a huge demand. I can't believe it. A lot of my apartments I'm converting not to short-term rentals, it's too much work, but to medium-term rentals.
Yeah, you're saying that. Yeah,
I did.
very interesting.
And it's, your rents are higher and work is lower, so I like that.
Yeah.
And then they show what kind of returns you can get as an investor. And then they show their social media. They do a lot of work with social media, and it seems to be paying off for them. They talk about who they are. Brad Cartier and Aaron Markle are the co-founders. Great guys. I've been coaching them for a long time. Here's another one they're doing. This one is close to Algonquin Park in Eganville. So they're converting this. This is an old campground or RV ground that they're converting to a tiny house town. And they've got 187 acres there. It's fantastic. They do lots of events in their tiny house towns. Like, it's important to create community.
Yep.
So
these ones here, like, they're like remote ones. People are living in these, or people are buying them for kind of like cottages per se, or glamping.
Well, my wife bought one, and it's basically for our family. We've got kids and grandkids to use.
Yeah.
Because they're so much fun. They have, I think, 3 or 4 ponds. They're all swimmable ponds, right? So you can swim in them. And they have music, and they have, if you want to drink beer, they got the beer garden, they got the golf, they got the craft brewery. They got all this cool stuff. So we use it for our family, you know, my kids and grandkids, and we'll go crash there and then put their tents up if they want, and enjoy, you know, because they do concerts there as well. But when their family's not using it, my wife puts it on short-term rental.
Yeah, makes sense.
But having said that, there are quite a few people who say, this is actually close to Rockland. I don't know if you know Rockland, Ontario. It's a little town of about 35,000 people, but there's an amazing amount of demand for medium-term rentals. So let's say a contractor is coming in to, you know, to do some work on you know, one of your projects, if it was in Rockland, and they need a place to stay for 3 or 4 months, furnished and fun.
So when they go in and build one of these communities, they sell, like, they lease land basically to.
It's exactly the same as,
bunch of different
it's exactly the same as the Park Bridge model.
Okay.
Right, so they put in all the services, right, the water, the power, and all that good stuff. And they actually build these tiny homes.
Yeah.
They sell them. They try and make enough money from the sale of them to pay all their infrastructure costs, and then they collect a land rent.
Okay.
Like I don't think we pay much in the way of land rent. I think my wife and I, we pay like $350 a month, but that's just because Brad and Aaron took pity on their poor professor, and I think everybody else pays $500. So don't tell anybody.
Okay. Yeah. Okay, that makes sense.
It's a great model, though. I mean, Brad and Aaron understand the Park Bridge model, and it can be permanent. It can be long-term rental. But as I told you, I think last time, the medium-term rentals are not, at least according to my lawyer, not subject to the Residential Tenancy Act, and I think that's an important change.
But the business model for them is to sell the unit and collect money on the lease of the land, not the short-term rental.
No, they'll do short-term rentals as well. They'll do short-term rentals, they'll do medium-term rentals, they might do long-term rentals. But because of the Residential Tenancy Act in Ontario, the long-term rental market is a bit tougher on.
But is like the main income stream from selling these units and collecting rent on the land lease, or is it them doing
the main profit driver is they make ridiculous amounts of money on their tiny homes. You know, they sell their tiny homes today. Tiny homes go for $100,000 to $200,000. You know, it's like an RV. If you buy an RV today, well, you can buy a secondhand RV for 15 grand, but you could buy RVs that are like unbelievable, that are like $300,000 or more. So tiny homes are the same. I mean, I bought a tiny home for one of my you know, workshop clients. I bought it secondhand for $35,500 plus HST. So you can buy, it's a nice little tiny home, but it's inexpensive. So the range is, you know, 30 or 35,000 for a secondhand tiny home to maybe over 200 grand for some of the big ones that are beautiful. The difference, though, is that actually for our backyard, we wanted to put an RV in our backyard. So when our kids and grandkids come, or actually for the men, the husbands who snore, we can put them in the RV in the backyard. But you probably know this, you cannot buy an RV in Canada, even the ones that are made in Canada, that are good below -3 or -4. It's ridiculous. I talked to some of the suppliers and I said, what are you kidding me? You're building RVs in Canada. And, you know, Ottawa's weather, it'd be -15 or -20 for 3 months.
Exactly.
It's not as cold where you are, but still, you would get days below -3 or -4, right?
Oh yeah, for sure. Well, not this year, but 100%. Yeah, we go down -15, 20.
And your water lines freeze, and the thing just is kaput, and it just tears itself apart in the winter. Like, how stupid is that? So I think tiny house investments are much better. You know, like I said, I could get a nice tiny house for 100 grand. I can rent it for 1,200 to 1,500 if I wanted to do a long-term rental. You know, and make it 8 or 10% cap rate, maybe a little bit higher. That's fine for me. I'm okay with that.
Yeah, makes sense.
On the workshops, I make cap rates of, you know, 16 to 20%. So the workshop is great. Like a workshop with all the stuff that we've done to it, you know, the reverse cycle heat pump. Oh shit, I gotta go. Reverse cycle heat pump, And the insulation and all the other stuff we have to do is about $26,000, but we can get anywhere from $700 to $1,000 a month for those.
Oh, really?
Yeah, so that is
That's
about
good.
an 18% cap rate, which is
Yeah.
pretty good.
That's
And
nice.
don't forget the workshops are plus HST plus power.
Yes, yeah. That's nice.
HST is your friend, right?
Yep, yeah.
Anyway, so I think, listen, I've recorded all of this. Sorry, we
Mhm.
jumped all over the place, but
Yeah, no worries.
you have a little bit of homework to do, and I
Yep.
want to hear from you, on a regular basis, okay?
Yep, sounds good.
See you, Jeff.
All right, thanks.